All right, welcome to this explainer. I am absolutely thrilled you're here today because we are going to tear apart, literally, the most frustrating trap in trading. And more importantly, we're going to talk about exactly how you can beat it. Look, if you have ever felt like you were just completely played by the market, you are in the perfect place. We're going to dive right in and master the mechanics of outsmarting false breakouts.
Because, let's be honest, we've all been there, right? You're watching a chart, you see a stock pushing past a major resistance level, and you get these massive, beautiful green candles. It looks like it's going straight to the moon. So naturally, you buy in. And then, literally seconds later, the floor just falls out. You suffer this instant, violent rug pull, and boom, you're trapped. It's totally maddening. But here's the real secret. It is not just bad luck.
So here is our game plan for today. We'll start with part 1, the breakout trap. Then 2, why algo flushes happen. 3, spotting the buildup. 4, confirmations and filters. 5, advanced tactics, looking at level 2. And finally, part 6, trading the reversal.
Okay, let's kick things off with section 1, the breakout trap.
So what is a fake out or a false breakout? Basically, it happens when the price pushes past a resistance level, fails to hold, and instantly reverses. But I really want you to notice that phrase, grab liquidity. See, professionals, they don't look at fake outs as glitches or mistakes. They know the market is a highly engineered machine playing a game of probabilities. It is actively hunting for retail stop losses. Why? Because those stop losses are the exact liquidity the big players need to fill their mass with orders. We've got to completely reframe how we view these sudden drops if we want to stop being the liquidity for the pros. Which brings us right into section 2, why algo flushes happen. You have to understand that there's a massive mismatch in the market. On one side, you've got us, retail traders, trying to manually catch the trend direction, and let's face it, we're often driven by emotion. But on the other side, you have market makers and high-frequency algorithms. Their goal isn't to guess where the trend is going. Their job is just to provide liquidity, buying when you sell, selling when you buy, and profiting from the spread. Think of market makers like inventory managers at a giant warehouse. They can't just absorb an infinite amount of stock. If a massive wave of selling hits out of nowhere, they have to manage their risk immediately. And that split-second risk management, that triggers a brutal chain reaction called an algo flush. Picture this. A massive block sell order hits the market. Instantly, the high-frequency algorithms recognize it, and they just pull their bids to protect themselves. Well, with the buyers suddenly vanishing, the price slips downward in a flash, sometimes dropping 10% in just seconds. And then bam, that sudden drop triggers all the retail stop losses sitting right below the breakout level, which flood the market as sell orders. It turns into panic selling, accelerating into a total flash crash. It's just this crazy, self-fulfilling snowball effect. So how do we avoid it? That's section 3, strategy to spot the buildup. First things first, you've got to stop chasing those parabolic moves. You know the ones, where a stock just shoots straight up with these huge, aggressive green candles. It is completely unsustainable. Why? Because there's absolutely no structural floor beneath it. If it reverses, there is no nearby support to catch the fall. It's just empty space. What you actually want to look for is a tight consolidation right below the resistance line. You want to see higher lows coiling up against the ceiling, getting tighter and tighter. That kind of sustainable buildup tells you that strong buyers are patiently absorbing all the selling pressure. And you don't even have to guess if that buildup is happening. You can visually confirm it. Just pull up your volatility and momentum indicators, something like the MACD histogram or your average true range, the ATR. You want to see that indicator getting completely flat as the price coils right up against resistance. When you see that shrinking volatility, it means the wild price swings are drying up right before the real explosive intentional move happens. All right, let's move to section 4, confirmations and filters. Pay close attention here, because this is where a lot of traders get completely wiped out. We need a strict 2-step confirmation process to filter out the garbage trades. Step 1, you must wait for a full-bodied candle to actually close above that resistance line. Just poking through the line for a minute isn't enough. And then step 2, this is the golden rule, guys. Wait for a subsequent candle to close above the absolute high of that very first breakout candle. If the price can't push past the high of the candle that originally broke the line, you are almost certainly looking at a bull trap. Seriously, I want you to burn this into your brain right now. No jumping in on wicks. If the price spikes up past your resistance line, but then the candle closes back down and leaves this long wick pointing up, that means sellers have already taken control. If a stock tries to break out and fails to close above the line by even a couple of cents, take that as a massive, screaming warning sign that a flush is coming. Now, if you want to be extra safe, use what's called the break and retest filter. It's super simple. You just let the price break the trend line, wait for it to naturally pull back, and watch to see if it touches that exact same line from the other side. If that old ceiling acts as a brand new solid floor, it confirms that the move is intentional and not just some quick algorithmic liquidity sweep. Okay, let's level up. Section 5. Advanced Tactics using Level 2. Have you ever heard of an iceberg order? Think of a massive institutional whale who wants to sell, say, 50,000 shares. If they just slap that huge number on the screen, retail traders are going to panic and the price will absolutely tank. So they hide it. They might only show 100 shares on the Level 2 ask. But as buyers snatch up those 100 shares, another 100 instantly replaces it, over and over again. They are quietly unloading a massive position without spooking the market at all. So how do we actually spot these hidden predators? You have to watch the tape, the time and sales window. If you see a massive wall of green buying, like let's say 30,000 shares are printing, but the price on your screen literally refuses to budge a single cent, you're buying straight into an iceberg order. And here's another huge red flag, the fourth tap. If a stock repeatedly taps a resistance level 3 or 4 times and then finally breaks it by just a penny or two before stalling out, hidden sellers are lined up. Just bail out immediately. Finally, let's flip the script. Section 6. Trading the reversal. See, professional traders don't just dodge these traps, they actually trade them. And here's the exact playbook. First, the market sweeps the high, grabbing all that retail liquidity. Second, the price violently rejects, leaving that long wick on the chart we talked about. Third, and don't miss this, you wait for the internal market structure to break. That just means the price drops and breaks below a recent low, proving that sellers are completely in the driver's seat. And finally, step 4, do not chase the drop. Wait for a slight pullback into a supplier demand zone and then enter your trade in the opposite direction. You're no longer the trap, you're riding the wave right alongside the institutions. All right, let's do a quick recap of this toolkit because it is incredibly powerful. Stop chasing those straight-up parabolic moves, wait for a tight, shrinking volatility buildup, force the market to prove it to you by demanding a full candle close and that high of high confirmation. Use your level 2 tape to spot those sneaky iceberg orders pinning the price down. Don't be afraid to trade the reversal once the internal structure shifts, and please journal your trades. Track your fakeouts so you know exactly which of these filters works best for your personal strategy. I'm going to leave you with this one final provocative thought. The market is not random. It is a highly engineered machine that is constantly hunting for liquidity to fill large orders. Every single time there's a false breakout, someone is getting trapped and someone else is making a fortune. The mechanics are right there in front of us. So the only question left is, are you going to keep providing that liquidity, or are you finally going to use these strategies to profit from it?